Welcome to the City Property Association's seminar on the City of London's resilience and its recovery from the pandemic. My name is Lisa Webb and I'm a senior planning partner and board member of Gerald Eve and the City Property Association. So it's been 4 months now since we were all locked down and the city went from being a thriving global business centre with 500,000 workers in every day to pretty much a ghost town overnight. As we all left our desks and went to our various dining rooms around London and the country to do our work online. Now, the government message is changing about returning back to the office, but for those of you who have been in, and you can see I'm in now, and it's good to be back, but for those of you who have been in, you can see it is a slow return, and the streets of London are very slow and very quiet. And the city's ecosystem, which includes 24,000 jobs in retail, leisure and culture, relies on office workers coming into the city to support it. So we're going to talk a little bit about these topics today. We've got an excellent panel who are going to talk from their different perspectives about what we can be doing to support businesses and giving public confidence in really coming back to the city and supporting that ecosystem, which is so important to its future. So firstly, we're going to start with Elaine Russell, who is the head of UK Offices Research at JLL, who's going to give us a market update. And then the panel discussion will include Dan Byrne, a CPA board member and lead director of Central London Markets at JLL, Alistair Moss, Chair of Planning and Transportation Committee at the City Corporation, and Mike Taylor, who unfortunately had a few technical issues, so is joining us by dialing in rather than being able to see him. But he is the co-head of Corporate and Workspace Solutions and head of real estate for EMEA at Goldman Sachs. Now, as well as the panel discussion, although we've got quite a lot to cover because there's obviously a lot of interesting things to talk about, there will be an opportunity for some questions and answers. So please do post your questions and hopefully we'll have time for some of those towards the end. And we're also, as I understand it, going to be running some live polls on some hot topics. So if you can also provide your feedback on those, that would be great. So I'm now going to hand over to Elaine to present her market update.
Just bear with me a second. Great. Can you see you can see my screen, I hope now?
Yes, that's great. Thanks, Elaine.
Fantastic. Thank you, Lisa, and good afternoon, everybody. As I say, I'm going to give you a very brief update of activity in the city office market, setting the scene really for the panel update. Not surprisingly, the office market has been slow as the impact of Covid-19 and large-scale working from home has impacted on corporate decision-making over the last few months. And you can see that quite clearly from the graph on screen, which shows take-up across the city. Following several years of robust leasing, with 6 of the last 7 years showing above average activity, the slowdown in Q2 is really evident. With just under 500,000 square feet of transactions completed. This is actually the lowest quarter since Q1 2009 and actually brings the year-to-date volumes to around 1.6 million square feet. But while that sounds obviously quite depressing, I think despite this inertia that's been evident across, not just across the city, but across the wider central London market, there were still some signs of occupiers taking longer term commitments, with 4 of the top 5 largest transactions being pre-lets. So actually what that meant was that pre-lets actually accounted for nearly half of all space let in Q2. And I'm sure you're all aware that the largest pre-let that signed this quarter was the pre-let to Covington and Burlington at 22 Bishopsgate for 86,000 square feet. One of the other things that we've seen during the quarter is that space under offer decreased. It fell to 1.3 million square feet. And this is really because during the quarter, a number of companies have placed their transactions on hold or actually downsized their requirements as they've been reevaluating their real estate strategy. But I think positively, what we've also seen is that there's still been evidence of deals going under offer since the lockdown, and actually few deals have actually been completely withdrawn from the market. The city typically has a diverse tenant base, and this is reflected in the longer term leasing patterns by business sector. But during the first 6 months of 2020, it's quite clear that the market has been driven mainly by professional services companies, and that's predominantly the legal market, very much driven by the 300,000 square foot transaction to Linklaters in Q1. Most of the sectors are ticking along in line with the longer term trends, but flexible offices have been kind of conspicuous by their absence over the first half of the year, accounting for just 5% of take up compared to a longer term average of 17%. And the impact of companies pausing and reassessing their requirements has also been reflected in active demand, so those companies who are actually actively looking for space at the moment. During the quarter, active demand in the city fell by around 17%. So we estimate there's around 6 million square feet of active requirements. And this is the downturns again really reflecting that the number of requirements being placed on hold or being reduced in size. I think the map's quite interesting, as this shows all central London demand, and it also shows which submarkets each of those requirements is considering. And I think you can see quite clearly the concentration of demand in the city submarkets, particularly the city core. So 56% of all demand in the market at the moment would consider or are considering a location or a building in the central city core. And again, I think that's pretty, if you look at that focus on the city in comparison to the West End, it is quite clear that there's a great shift or a great focus on those city submarkets. And I think it suggests that the continuation of migration from west to east is likely to continue, recognising the improvements to the city environment, the breadth and depth now of the F&B offering, and the area's connectivity, of course, as well as obviously, of course, the lower costs of occupation. The slowdown in the leasing market was really also reflecting a rise in vacancy rates across the city over the quarter. The vacancy rose to just under 5%, but that's still below the long-term 10-year average of 5.5%, which you can see by the red lines on the graph. If we look at the vacancy for new space, a slightly different picture is evident. The supply of new space remains relatively restricted, with about 500,000 square feet currently available. And that just reflects a vacancy rate of 0.5%, and that is less than half of the 10-year average of 1.3%. So what has driven this increase in supply? Well, the rise in supply has been predominantly due to an increase in second-hand supply during the quarter, which has not obviously been absorbed by leasing activity, which would typically be the case. The graph on screen shows the pattern of tenant-led space, which reflects changing occupier strategies from some occupiers across the city. It's worthwhile mentioning that this increase in tenant-led space coming back to the market was actually already expected, and actually is really pre-COVID related. And so I think so far we've not really seen any significant evidence of occupiers placing space on the market as a direct result of COVID. So these are part of longer term strategies that were already being implemented. And I think the other point is, in terms of a percentage of overall supply, tenant-led space remains relatively low by historical standards. I think the other thing to bear in mind is that a major share of this second-hand space is for short-term leases. So we estimate around half of available space is on leases of less than 5 years. So that's not going to compete directly with that prime new space on the market. And actually, that's a kind of nice segue into looking at the development pipeline. So we expect new supply to remain limited due to the strong pre-leasing activity, and also delays to construction as a result of Covid-19. And the graph on the right shows you the development pipeline by completion year. There were no starts during Q2 as developers paused in the light of the pandemic. While development has generally resumed on site following initial halting in the aftermath of the initial lockdown, we're now starting to see delays to completion dates quite evident, and that's likely to push the pipeline out by about 3 to 6 months. And in fact, pre-COVID, we estimated there's about 5 million square feet completing in 2020, and that's now fallen to around 4 million square feet as completions have been delayed. And I said the market's also characterised by high levels of pre-letting activity, and half of all space under construction now has secured a tenant. So this is only going to add to the pressure on new supply and should help to support rents for the best space in the short term. I think at this point it seems quite sensible just to consider the supply today compared to previous economic shocks. There's quite a lot of bars on here, so I hope it's clear enough. We know that in previous downturns, vacancy rates increased sharply due to a combination of slower leasing activity and higher volumes of speculative development underway at the entry point. And on screen here, we've got total supply split between new and second-hand space, and that's overlaid with the volume of spec development underway at each point in time. As we entered the Covid-19 crisis, across the city, there was about the same volume of space on the market as there was in the 2008-9 recession entry point. But I think the one thing that is very different this time around is that volume of speculative development underway. And that's that light bar on the graph. In 1989, if we go back two downturns ago, there was 8 million square feet under construction, which resulted in that spike in vacancy in the years thereafter. If we look at the start of the GFC in mid-2008, there was 7.7 million square feet under construction. So that compares to just 4.1 million square feet today. So that's actually a significant difference. Obviously, in previous downturns, we also saw a significant rise in second-hand space coming back to the market, which we've just touched upon. And so that's just reflected in the black bar. So look at the difference in the black bar between 1990 and 91 and 2008 and 2009 to see the impact. But I think generally due to that lower levels of new supply expected to come through, we don't really anticipate supply increasing to the same extent as perhaps we saw in previous recessions. So quickly turning to the investment market, from an investment perspective, I think a similar level of inactivity has been evident during the quarter as COVID has impacted on activity. Investment volumes totaled just over £300 million in Q2. That was down by about 3/4 on the Q1 total, and is really kind of in line with the low levels of activity that we saw during the global financial crisis. So overall, the H1 total is just £1.6 billion, which you can see from the graph, it is significantly below activity that we've seen for quite some time. What we saw since lockdown is that there have been no transactions completed in excess of £100 million, which has typically underpinned those stronger volumes that we've seen in recent years. And the largest deal to complete this quarter was Mighty Divine's purchase of 10 Fenchurch Street, which sold for about £95 million. There's not really been any significant pattern in terms of source of capital. UK buyers were probably the most active in terms of involvement in terms of the number of transactions, but they were focused very much on smaller assets. So overall, overseas money dominated. You can see that by the dotted line heading towards 90% in terms of money transactions actually completed. But I think with travel restrictions easing, we're now seeing greater interest from overseas buyers once again. And so I think we expect interest to pick up in the second half of the year, and hopefully that will translate into greater volumes of transactions. I think it's also just worth pointing out that while overall investment was down in 2019, just to put that into context, this is primarily due to a lack of quality supply as opposed to a reduction in demand from investors. So the majority of commercial real estate owners were seeking to hold assets rather than sell. So that's what led to the reduction in investment volumes. And there was a significant wave of overseas capital waiting to come into the market. And we anticipate that some of that will come back as certainty returns to the market. Just looking at yields, the majority of global property markets have seen significant yield compression in recent years. And you can see that on the graph on screen that prime office yields in many major cities around the world are now below 3%. But you also can see quite clearly that that's not the case in London. So the best-in-class prime office yields for the city now stand at 4%. So that's offering investors really strong value and a healthy arbitrage compared to bond yields. I think given the additional risk in the economy at present, it's likely that yields will remain flat. We expect some of the other global markets to see pricing soften considerably, but I think London will be more resilient due to its existing value, and I think the preference of investors for those established safe haven markets. And just following on from that, to end on I suppose, a slightly more kind of positive note, we've just released our latest global transparency, real estate transparency index, which shows the UK still remains the world's most transparent market, for factors that you would expect: high levels of liquidity, the strong legal and regulatory framework, and robust governance, for example. But of course, for cross-border investors and occupiers, it's really important to understand the difference in transparency between cities, as they look to understand the nuances of market openness and risk across competing cities. And positively, London is ranked first at city level, well ahead of its European rivals, who, as you can see from the top 10, actually they didn't even make the top 10 in our index. And real estate transparency really plays a crucial role in a city's success by attracting new investment and business activity. It enables long-term planning, it enhances community well-being and safeguarding the environment. So it's a real positive for London to be placed at the top. So I think on that note of resilience, I'm going to hand back to the panel.
Thanks very much, Elaine. And I'm sure we'll pick up on some of those themes as we go through the discussion this afternoon. And it's, certainly good to see things like the strength of the active demand there for the City of London. And this also reflects actually a survey that the City of London Corporation commissioned, which Alistair may pick up on later, of over 500 investors who have confirmed their confidence in London going forward. So yeah, some positives in there, certainly. So turning to the question of the impact lockdown has had on the city, Dan, if I can go to you first, how important do you think the office worker is to the city's ecosystem? And what do you see the key challenges are for getting the workforce back in the short term?
So hi, Lisa, and everybody else. So look, the ecosystem is vital for the City of London, but in order for it to work, it needs all the parts to be present. And therefore, the only constituent part is the provision of the amenity itself, but the purchasing power of the actual office occupier is absent, then the system is not going to work. We need people back in their offices so that the bars, the shops, the restaurants, the florists, hairdressers, nail bars, the taxis, trains, buses, so they could all fulfill their roles within the city ecosystem. And I think when you put into the context that that each of those constituent parts have their own purchasing power within their own ecosystems, if we don't kickstart ours, they can't kickstart theirs. And therefore we get this build-up of a problem that will just create even more of an issue for the economy.
Okay, and I think we've had our first poll on issues preventing return to the office. I mean, are there anything that you've seen from JLL that you want to pick up on that, Dan?
Yeah, so for me, there are a number of challenges that we're facing in encouraging the workforce to come back into the work arena. I think the first is the rules that were imposed by the government on working from home, albeit that's now been amended and the control is very much returning now and being vested in the business leaders themselves to determine who, how, and when they return into the office environment. This is a positive move because it's no longer controlled by government, and it means that businesses, if they act sensibly, and not just from the view of protecting their own staff, but they must have a wider perspective of the impacts of not returning to the office or a slow return to the office that it'll have on the wider economy. So I think secondly, that furlough, which whilst the government has responded robustly in its attempt to prop up the business environment through the furlough scheme, there is a belief that whilst this continues and businesses rely on it, there is little to encourage businesses and people to come back into the office. I think the scale of what has been provided and the future impact on businesses, though, and the country is yet unknown, but it's got to lead to higher taxes. And one of the remedies are the taxes that are collected. But if there is less taxable income because people have been laid off, because the productivity has fallen, or if businesses are no longer in a position that their revenue stream has fallen, then the government is going to have to impose other taxes upon society, whether that's higher corporation taxes or personal taxes, and that's just going to frustrate business and people even further. I think thirdly, and probably one of the most important pieces, is the public transport. And I think what we've seen is this has been referenced widely in the press as one of the main barriers for people returning to the workplace. People being scared of traveling on crowded tubes and trains. My own personal experience is right now, there's nobody on them, probably the safest place to be. And whilst it's totally understandable that people don't want to be crammed into trains and tubes, I think that the prospect of those, the companies, the travel companies actually setting up sensible limits to people in carriages and how people will travel is really important going forward. But I think a lot of businesses have also got to start questioning the fact that their own employees are very happy to visit the parks, the beaches, the pubs. They're traveling on planes to Spain and other parts of the world now that we've opened up the sort of air travel experience. And I think that certainly from what I've seen out there, there's very limited social distancing that's happening in those environments. And so if you're happy as a person to go and do that, why aren't you happy to get on a train and go to a work where most businesses have now spent considerable amounts of money putting in proper social distancing rules and regulations. I think though from what we've seen from our junior staff on the travel perspective is that, you know, whilst many of them had travel passes that they had bought at the beginning of the season, they cashed those in at the beginning of lockdown. And now actually when they're being told, you know, we'd like to see you in the office 1 or 2 days a week if you don't mind traveling on public transport, the thought of actually physically having to spend 30 or 40 pounds on a ticket, I think is also acting as a bit of a barrier for some of these staff to get back in. And I think we need to start to encourage them that if you don't start spending the money to get yourself into the office, you may not be coming into the office in the longer term in any event. So I think whilst that's probably quite a harsh statement, the reality is if we don't start to kickstart the economy by getting back into work, there's going to be far greater problems that we're going to have to deal with. I think the other slight 2 or 3 other areas that we need to think about and that have caused a slight delay. Fantastic weather we're experiencing at the moment. You know, it's not really the choice between staying at home and benefiting from being in the garden for a period of time rather than being in the office. That's also weighing on some people's decisions, along with the fact, I think probably more pressing is some of the homeschooling that people have had to go through, and the fact that now you don't have the holiday clubs that many relied on in the past because they're not up and running at this stage. And I think if we can start to get some of those returning and people being able to put their children into holiday clubs and back into school, then I suspect that from beginning of September that might also help ease some of those restraints of coming back. And then finally, I think the whole public statements and knee-jerk reactions that we've seen from people about productivity, working from home and how it's impacting their businesses, the reality is that a lot of those people making those statements are probably execs who are sitting in their nice country residences. But I think they need to actually start thinking about some of the workforce. And certainly the polls that we've taken from some of our staff at the junior levels are that actually the whole mental health position and issues that many of them are starting to experience through lack of social interaction and the prolonged periods of isolation, that's going to have a profound impact on business going forward and those people. And I think that, you know, the majority of the workforce, and I don't know the exact stat, but I suspect over 60% of the workforce is probably sub 35 years old. And many of those people are working in shared accommodation and flats. And so, you know, it doesn't bode well when you're having to share the table in your kitchen with 2 or 3 other people that who may not be within your industry trying to do the work. And therefore, I think businesses are very soon going to start to see a lack of productivity and a huge amount of inertia starting to spread amongst their workforce. And so I think that the encouragement that they can do is get people back in the office and into a proper working environment.
Thanks, Dan. I mean, everything you say is very reflective of what we've experienced as well at Gerald Eve and the key challenges around childcare and also the fact that actually, and transport, and actually on our poll, public transport was the key issue preventing people coming back in. But what we have seen as well is those younger members of staff are the ones who are actually keen to come in and want to keep coming into the office, which is great. But yeah, these other challenges need to be addressed in order to get the majority back. Alistair, from the city's perspective, can you tell us a little bit about what the city's doing to enable workers to come back, and in particular talk a little bit around your transport strategy, and also what wider support do you think the city corporation needs from either from government or other parties on this?
Yeah, sure, Lisa, and good afternoon, everyone. I mean, I suppose from the start of this pandemic, we've been determined to first deal with that, but second, to be looking for the future and to be kind of looking to see how the city will come out of this. And the work that we've been doing over the last few months has very much been an acceleration of what our transport policies were really over the last couple of years, which in a nutshell is making the city a better place to be, a place where people enjoy walking and cycling, they enjoy good air quality, they enjoy good road safety. And it's all about that attraction of international talent to a city and incentivizing people here. And I suppose with the pandemic, there's this additional layer for all the reasons that you and Dan have just discussed, that is all about bringing people back to the city now to give them that confidence. And I think from March time onwards, our messaging has been that along with government at the top level with the transport there and occupiers in terms of all the COVID proofing that has been done to thousands of workplaces at massive expense, we have been busy in the middle, so to speak, dealing with all that public space that is the road space and pavement space in the city. And central London is looking different now. It's quiet, but a lot of streets have changed, and a lot of streets are looking better, and they're going to be looking better and better over the next few months. We're going to have more tables and chairs, stuff outside, happening outside, but also more space to walk. So people shouldn't be concerned about socially distancing when they're walking on the pavements. People will be able to cycle far more safely than before, and basically giving that satisfaction. So as you say, there is the issue regarding, and certainly seeing the questions, regarding the national infrastructure in rail and things. But let me assure anyone listening now, once you get out of the station or wherever you are in the city, you're going to have a pleasant experience and a safe experience from the moment you leave there right into your office and wherever you're working and meeting and things. And that's why people are coming back, and we do need to come back. It's very, very clear. I think on that national transport policy and how TfL will handle things, I know that they're acutely aware of this, and some of it will be simple solutions. Like, for example, in the firm I'm working at, where we have booking systems, so people will come in at different times of the day. If people are traveling at different times on transport, that will automatically spread things out. We may have booking systems on transport just generally and other things, and just taking some personal responsibility for that. But I really would implore us all, I think, as a property industry and a local authority perspective, to be thinking about and trying to inculcate in people's minds now what those journeys will be like as we return, for them to be thinking about that now. We can't be thinking about this in September and kind of planning for the future at some time. It needs to be now that we're getting to people's minds and providing that reassurance to them, I think now. So in summary, a lot of work has gone on and is going on from the City Corporation to make the city a very safe place, and a place that people will feel welcome as they gradually return to.
Great, thanks, Alistair. And Mike, picking up on this, Goldman Sachs is a major occupier in the city. You've got something like 6,000 staff, and you've been encouraging them to come back. How have you been doing that? And can you tell us a little bit about what you see the importance of the physical office is, alongside the flexibility of working from home?
Yeah, sure. And, so I think, one thing first and foremost, we've had about 200 people in the office throughout, given their key work is, supporting the financial markets, particularly in fixed income and equities. And we've seen some real momentum really since June, and increasingly with the government advisory. And that was key. And there was, I think, a missing piece actually, as it relates to then the use of public transportation, where the government has also now pivoted. And we've got four tenets really that sit behind this. It is government advisory first and foremost. We also then, monitor and check community readiness, and so we map a demographic of our people, and we look at cases, actually across that demographic rather than nationally, to make sure that we feel comfortable above and beyond government guidance, for our own stats and analytics. And then the third tier is, the building readiness. So we're fortunate that, frankly, I think we really have a gold standard in terms of how we have adapted to ensure we can make sure we've got that social distancing across our workplace and measures in place for people to feel safe. And, last but by no means least, probably most importantly, it's the readiness of our people. And really, at least to answer your question, when you look at the human interaction, the spark and energy and passion that you get from being in the office, many times when you're actually sitting at home, you're actually giving across Zoom, but you don't get that same energy and buzz. Quite the opposite. It's, in many instances, dilutive. And, we're fundamentally a client-facing business. We thrive off of that impromptu kind of conversation at the tea point or across the workplace, that then drives that cross-pollination of ideas in order for us to be able to serve our clients best. And, equally, a large part of what we do as a bank is risk management on behalf of our clients and to be held to the obligations of our regulators. And one has to just keep, not back of mind, but front of mind, that it has been an extraordinary period of time. And I think it is fair to say that that risk management function is better served when you've got proximity of managers to their teams and teams collectively together in order to drive those processes and protocols. And, last but not least, and I would say this, but all those things, combined together, frames for a happy, productive, workforce who want to come to work. We've all got the same opportunity to hire the same people. It's very much about how those people come together and the culture that you drive through the organization. And I think, again, that's diluted in a remote environment. So there's a real force behind this, particularly here at Goldman Sachs. But equally as, pleased to see the chairman of PwC came out just today in a letter to the FT weighing in behind this. Not least in their part and forefront in our minds, and it's really, as Alistair just touched on, and equally Dan, there is a strong element that sits behind this of the broader corporate social responsibility that we owe to society to get everything back on, its feet. We're privileged as it stands, but that won't last unless we all weigh in. First and foremost, ensuring our people are safe, but with that, getting the broader macro back on its feet.
Thanks, Mike. And yeah, I mean, there've been a few comments on the chat here about the benefits of working from home. And I think we've probably all benefited to some extent from having some time working from home over the last 4 months. But I think that the key point is that collaboration point, Mike, that you mentioned, about the need to be in the office to really be able to benefit from that. And also, I think training and mentoring as well. You can't, there's no substitute for that. So I think personally it's going to be a balance going forward, but with the office playing a very key part, but with working from home certainly will be around in the future, I'm sure.
And Lisa, I just processed overlay to that, because that's really important to distinguish between those considerations specific to COVID and then most broadly, what people want and what we need to provide by way of choice. And I think that's super important. The government has asked everyone to undertake a framework of consultation, and that's what we're doing. And it's really important, that messaging, to ensure that people don't think that you're taking away that flexibility. Quite the opposite. That's going to be a long-term trend, in my opinion. But it's two separate discussions. Yeah,
no, absolutely. Okay. I mean, looking now to the future of the city and sort of opportunities and trends that might be emerging from the pandemic and from lockdown. I mean, I can comment from a planning perspective that there's still a lot of significant appetite for development in the Square Mile. Over the lockdown period, the city's run its planning and transportation committees, and we've had major schemes go through that, including 50 Fenchurch Street, a new office tower, the new Museum of London at Smithfield, and more recently the redevelopment of Millennium Bridge House on the river. And there's also, you know, a significant number of schemes going through the application system at the moment, and also the pre-app system. So, you know, the industry is certainly keeping the city's planning department busy, which is great. And in terms of trends of what we're seeing coming through in terms of schemes, I think for me, it strikes me that it's really just been an acceleration of trends that were already happening. So we're seeing buildings that are being designed now to be much more flexible, to enable people to work in different ways, to have more of this collaboration space, the need for office and outdoor space, amenity space within offices, and you know, that real focus on well-being, which again I think has just been accelerated over the last few months in terms of encouraging people to use stairs rather than lifts. And I think we'll see an increased role in technology as well in terms of security and other measures within buildings. So they're sort of some of the trends that we're seeing coming through in terms of design of buildings. I mean, Mike, coming to you first, why do you think the City of London's an important place for business? And do you see the city's role changing as a response to the pandemic?
Yeah, so we've been literally within probably a square mile ever since we opened our first office in the UK, and that's, you know, in the heart of the city. And so we've always been firm believers. You know, in fact, you know, recently we doubled down on that. You know, having bought a, you know, large tract of land and then built a 1 million square foot building at £1 billion. So we've gone long on the city because we're long-term believers in the city. And I think it's lent well to our ability to competitively hire over time, particularly when a number of the banks went down to the wharf. And I think a lot of it talks to that kind of social infrastructure and buzz. And to Dan's point, you know, earlier, the average age of Goldman's globally is 34 years old. You know, we've got a lot of kids who enjoy the vibrancy that exists in that ecosystem that he also talked about, and we've seen that change over time for the better. So I think, you know, the focus on the public realm, open spaces, kind of talks a little bit to COVID, but it's not COVID linked. You know, it's a long-term strategy, together with that urban mix, you know, of retail and leisure, which, you know, people thrive on. So I think, you know, for us, we will undoubtedly continue to be anchored in the heart of the city. We frankly lucked in a little bit with Crossrail and the north-south crossing, which is the only place to do that, you know, across London. And we see that as a positive attraction. We have 3,800 interns that we hired through our program this year alone globally. And that pipeline is tremendously important for us. And so I think, you know, those are the fundamentals which lend themselves to be able to competitively hire and for your people to be productive and for that level of retention rather than attrition, which counts so much for growing a business over the long term. But I do think, and Dan also touched on it earlier, and you know, also Alistair, in terms of the transportation strategy, I do think there is still work to be done. Because as we do run through these consultations with a lot of people, one of the overriding factors is actually, you know, concerns around public transportation. And I don't think that's going to go away. You know, I do think that not in the city specifically, but on a broader macro across the UK, and hopefully Boris and the government will lean into this. We do need to make that investment. You see it in Frankfurt, you see it in Paris. We are behind here. You know, hopefully Crossrail will come. No published date as yet, but these are the types of initiatives that, you know, if we can get that infrastructure set right, then, you know, we will continue to be competitive, not only in hiring, but also in the broader GDP of the economy and London being a competitive place to do business.
And just picking up on that, Dan, Elaine talked earlier about international investment, which has been a key part of the city's market over the last few years. How do you see that in the future?
Yeah, I think, look, London's one of the world's most traded cities, full stop. Overseas investment into the city's averaged something in the order of £6.6 billion a year over the last 10 years. And I think, you know, whilst activity slowed in 2019, and that wasn't directly related to COVID, you know, the city has accounted for something like 75% of all volumes in London in the last 10 years. I think the uncertainty around the date to leave the EU caused some issues. The low supply levels and concern over the position of the cycle combined to reduce the activity in 2019. But there were some positive signs pre-COVID of a greater international interest. However, I think that the levels of activity have been incredibly low, and whilst we're starting to see some signs of activity and a thought from the international stage, many of those and many of the large transactions that you see in the city do involve the overseas buyers. And I think at the moment, part of the issue is they're not able to get here physically via the transport network in terms of planes and coming to London to see it. And so I think right now we're going to see a slow recovery from the international market, but there's definitely signs of life in terms of it opening up. I think that lack of ability to physically inspect has meant that unless you have someone on the ground here as an intermediary, it is going to be difficult to do so. But look, London offices, due to the scale of the purchases and its internationalization, tends to be very reactive to the political and economic events. And so once I think we return to a more normalized market post-COVID, we expect to see the positives of our relatively stable political environment start to encourage further overseas investment. Principally, London remains highly attractive for a number of reasons. Transparency, which Elaine alluded to earlier, the liquidity of the market. There's a very strong occupational market that we've had in London over the last few years, and whilst it's tempered at the moment, we do expect that to kick back once businesses start to return and focus on their long-term aspirations for occupying buildings in the city. And I think we have a huge reputation for being a great hub of innovation and talent. And Mike alluded to that in terms of them as a business. A lot of the people that they employ, they're similar workforce to the people that Amazon and Google and Facebook are trying to attract. And we know how their growth plans within London have massively accelerated over the last few years. I think finally, the UK leases are also, they're still long in comparison to other global cities. And in the city, Elaine provided me some information earlier, the average WALT in terms of turn certain left around the city leases is something like 6.5 years, which is long compared to other countries such as Germany, France and China. And I think also will put us ahead of the pack when some of those overseas investors are starting to consider investing again. And then I think in order to maintain our position on the stage across the world, we need to be proactive. We've got to create interesting and vibrant environments. And certainly the city has, as Alistair was saying earlier, they've invested huge amounts of money on the streetscape, generating really exciting and vibrant locations. And I think, the best-in-class buildings that we're providing, ever more so in the post-COVID world, we're going to have to be looking at the levels of specification and how occupiers interact within buildings. And I think that's going to be a hugely important point. And if we can maintain our position as delivering best-in-class buildings and having a best-in-class environment, then I think that ultimately will lead to greater overseas investment into the London market.
Thanks, Dan. Alistair, the city obviously has the benefit of looking long term, and it's been through many changes in its history. Do you think there are lessons that can be learned and positives that could be taken from this for the future?
Well, I suppose, as you say, the city's always played a very, very long game. I say the difference, thinking about this, is that this pandemic has basically been about a denial of space. Well, that's what we've had for the last kind of few months. And I think the positive of that is it's really kind of taught us a lot about ourselves, our businesses, our business relationships and things like that. And that's all positive, and it allows us, not just in our transport policy, but how we occupy, how we look at space and how we look at utility and how people want to work, etc. Through a different lens. And, I'm hearing nothing but positivity. I can tell you we're very confident. The surveys we're getting, we recently surveyed 500 or so global investors, and 4/5 of them said that they would be considering funding and investing in the city in the near future. I mean, you know, we are massively stable and on top of this, in my belief, and we've got a great product to sell, basically, and that's why people come here and coalesce here. What we need to be clear about, I think, as a collective, is why we need to be here, why that physical space is so important, and it's for all the reasons we've just heard from Mike and from Dan. And it's, you know, kind of that obvious things, but so we've learned a lot about ourselves, I suppose partly because we'd never really been denied that human interaction before on such a grand scale, and now we know it. I think we've kind of got to rather implement it. I mean, in terms of the history of the city, it does remind me rather of, you know, a year ago or so, as Dan was just alluding to, and over the years, you know, these questions about Brexit and things like that. You know, we've survived, you know, greater pandemics than this, you know, bombing, fires, etc. You know, the city has always been a centre of innovation for the world. It doesn't mean to say we should be complacent at all, but my goodness, you know, if we can't be innovative and creative and come out of this better, then no one else probably can. So that's why I'm really clear about the fact that the city has a very, very clear future on this. And what I would urge people to do is to see that for themselves, and urge other people to see that for themselves as they feel comfortable, as they feel safe to do, and to really coalesce around this point of how we make that safer and how we get there.
Thanks. And the final poll we had about opportunities, it was clear that everyone thinks improved public realm in the city is an opportunity going forward. And you know, we know this is the work the city is doing on that. And I think that's absolutely right. And we'll look forward to seeing that continue in the future. We have got time for probably just one question because we are running slightly late, but I think it's, Alistair, I'm going to ask you this one. I think I know the answer to this, but I'll ask it anyway. Given the impact of lockdown on the ecosystem that we were discussing earlier, does the city think it needs to revise its planning policies to encourage more residential within the city?
I saw that one. Yes. So I think, you know, that question. Well, first we've got to acknowledge there is still a housing crisis. There is still an affordability issue for those people we're talking about here. That all of us have talked about the fact there is generally a young workforce of global talent coming to London, and it is a major problem that affordability still is not sorted. So I would caveat what I say with, you know, that recognition and the city corporations playing its part on that. However, there has got to be very, very clear policy from the part of the city about having space which can adapt and change and innovate for the reasons I was just talking about. And the reality is that lots of residential does not generally allow that. Now, there's some great residential developments and great residential areas of the city, but what we've got to be careful of is having, you know, coalescing of both business and residential together. I think I've heard this question asked before, and I don't know, you know, kind of the motivation of it, but there is this kind of talk about, well, is there a future for the city? Really, offices really need to turn to Resi, PDQ, otherwise we'll just have lots of abandoned buildings. You know, the conclusion I would hope of hearing firms like Goldman's and JLL speak is that just isn't true. Certainly in city centres and where you've got good quality office, you know, that it would be a major mistake to occupy space, which is so important for international and national importance with residential use. So I think there is always need for housing, but I don't think this is the answer to now convert lesser used offices, currently less used offices in the city, suddenly to residential.
Thank you. Okay, that's great. Well, I mean, I think it's been a really interesting discussion this afternoon, and obviously a very hot topic at the moment. So thanks very much to Elaine for your presentation and market update, and to all the panel members for taking part in a very interesting discussion, and to everyone who tuned in and also contributed through the chat and Q&A. Just a reminder, you'll be able to watch this on the City Property Association website, as well as other previous webinars that have been recorded during lockdown. So thank you very much to everyone, and good afternoon.